You can feel it, right? That buzz in the air, that feeling that we are right on the edge of something huge. AI stocks are just through the roof. Fortunes are being made, it seems, overnight. And it really feels like we're watching a technological revolution happen in real time.
But for anyone who remembers the last big tech boom, this all feels a little familiar. And that brings us to the big question we're tackling today. Is this AI gold rush just the dot-com bubble all over again? Are we partying like it's 1999?
Okay, let's just start with the sheer scale of what's happening right now, because the numbers are, well, they're staggering. In just the past year, private AI companies have raked in over $65 billion. And honestly, that's not even the whole story. The tech giants are in an all-out arms race, pouring hundreds of billions more into building out their AI infrastructure. The amount of money flowing in is just, it's undeniable.
Now, to really figure out if today is just a repeat, we have to jump in the time machine. We need to go back and really dissect the original dot-com bubble to understand what made it tick and, what made it blow up so spectacularly.
And wow, this timeline right here, it just perfectly captures the mania. I mean, think about this. From 1995 to its peak in March 2000, the NASDAQ went up 600%. People were becoming millionaires overnight. But the crash was just as fast and just as brutal. By October of 2002, the index had completely cratered, wiping out every single gain it had made, a 78% plunge from its peak. It was a rude awakening, to say the least.
So what was the total damage? It's almost hard to wrap your head around. When all the dust finally settled, the stock market had lost $5 trillion in value. Trillion with a T. It was a complete and total wipeout of wealth on a scale that's hard to even imagine.
So what was fueling all this? Well, it was pure speculative fever. And this quote from Congressman Sam Rayburn from decades earlier just nails the fear that regulators had. The worry was that anyone could get into the market on a shoestring, basically borrowing money to gamble on stocks, and then wake up as a sheared lamb, meaning completely broke. And that is exactly what happened.
The business models back then were built on this exact mindset. The whole motto was get big fast. It was all about growth. Nobody cared about profits. Companies would raise a ton of money in an IPO and then just light it on fire with these crazy marketing campaigns, like those infamous Super Bowl ads. And that led to legendary flameouts like Pets.com and Webvan. They really became the poster children for the era's excess.
Okay, so that's the ghost of markets past. An era of hype, of shaky business models, and one spectacular crash. So now, let's get to the main event. How does today's AI boom stack up against all that?
And this gets to one of the biggest differences. Just look at the two sides. On the left, you've got the dot-com era, basically a house of cards built on burning cash. On the right, you have today's AI leaders, and they're more like fortresses. We're talking about the titans. Microsoft, Alphabet, Amazon, companies with absolutely massive balance sheets and tons of free cash flow.
And the numbers really back this up. Back in the dot-com days, a mind-boggling 36% of tech companies were losing money. Today, that number has been almost cut in half, down to 20%. The entire tech sector is just on way healthier financial footing.
And where the money's coming from, it's a completely different story. The 90s were all about IPO mania. Startups would rush to the public market to get cash from regular, speculative investors. Today, this AI revolution is being funded by huge, sophisticated private equity firms and by the corporate giants themselves, using their own massive piles of cash.
So here's the million-dollar, or maybe trillion-dollar question. Are valuations just as insane today? This chart kind of tells the whole story. It compares tech stock valuations to the rest of the market. Back at the dot-com peak in 2000, tech stocks were trading at more than double the valuation of everything else. I mean, that's pure speculation. Today, that premium is much, much lower, around 1.34 times. So are things expensive? Yeah, but are they historically crazy? Not really.
And there are a few other huge differences we got to talk about. First, remember the Y2K bug? That created this one-time non-negotiable deadline that forced companies to spend years' worth of their IT budgets all at once, which created a spending cliff the market just fell right off of. Geopolitics has also done a complete 180, from globalization to data sovereignty, which actually drives more local investment in AI. And finally, the big picture. Back then, the Fed was jacking up interest rates. Today, the overall environment is way more supportive of growth.
So, it seems pretty clear this AI boom is not just a carbon copy of the dot-com bubble. But, and this is a really big but, that does not mean there aren't any risks out there.
In fact, while everyone is staring at AI, the biggest dangers to the economy might actually be hiding in some pretty old-school places. And to find these risks, we're not scrolling through tech blogs. We're going straight to the source, the FDIC's 2025 Risk Review. These are the folks who insure our bank deposits, and it's literally their job to spot trouble before it gets out of hand.
And what are they worried about? Well, it's not AI, it's things like commercial real estate, where vacancy rates are on the rise. It's high levels of corporate debt, especially something called leveraged lending, and it's consumer debt, with more and more people falling behind on their car loans and credit card payments. These are the pressure points they're watching like a hawk.
Let's make this real for a second. In commercial real estate, a massive construction boom has led to way too much supply. For apartment buildings, that pushed the vacancy rate up to 8.1%. So why does that matter? Well, those buildings are usually bought with borrowed money, and when they're sitting empty, it puts a ton of stress on the banks holding those loans.
And that term, leveraged lending, you might be wondering what the heck that is. It's pretty simple, actually. It just means lending money to companies that are already deep in debt. It's a riskier game, and the FDIC is pointing out that default rates here are starting to creep up, which could spark a domino effect of financial problems.
So, what do we have? We have an AI boom that looks fundamentally different from the dot-com bubble on one hand, and on the other, a whole set of real-world economic risks brewing in totally different areas. Let's put it all together and figure out what you should really take away from all this.
So, what's the bottom line for you? First, this AI boom is not just a sequel to the dot-com bust. It's built on a much, much stronger foundation of real profits and products we actually use every day. Second, that doesn't mean you can just ignore the hype. Valuations can definitely get stretched, so you've got to be selective. Third, and this is so important, we all need to look sideways. While everyone's watching AI, the biggest risks might be in places like real estate and corporate debt. And that leads to the last point. Context is king. You have to see the whole board, not just the shiniest piece.
Look, at the end of the day, the financial world of 2025 is a completely different animal than it was in 2000. The companies, the money, the economy, it's all changed. But has human nature changed? That tendency we have for speculation, for getting swept up in the excitement, that's timeless. So maybe the real question isn't if the next crash will look like the dot-com bust, but what new and unexpected shape it's going to take instead.